Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Kroger stock by analyzing their financial statement and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 36 billion market cap. They're trading at $49 a share and they have 729 million shares outstanding. Kroger is a food and drug retailer in the United States. The company operates combination food and drug stores, multi-department stores, marketplace stores, and warehouses. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow was $4 billion in 2021 and it seems to be going down. It fell to $1.4 billion in 2023, back up to a little under $3 billion in 2024. Supermarkets have really low margins. They only convert 1 to 3% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's between $1.5 and $2.5 billion a year. Also really low margins, 1 to 2%. That's just the name of the game. They sell a lot of stuff, but razor thin profit margins. But when you have 150 billion of revenue, even if you convert 1% of that revenue to profit, it's a lot of profit. Revenue is a sales for the company, and that goes up each year from 130 billion to 150 billion. Nice steady growth. And you can see they have a really low price to sales ratio. Price to sales is stock price over revenue per share. So it's 50 over 200, or 1 over 4.25. Their dividend yield is 2.35%, which cost them $839 million. A good way to figure out if they can maintain the dividend in the future, look at how many times their free cash flow covers the dividend. And they cover it 3.5 times. Anything above 2 is good. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 62 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $56 billion. We divide that by 700 million shares. And we get a calculated stock price of 76. They're trading at 49, so they're trading at a 36% discount. It's a buy according to the model. I usually take the WACC from Finbox, and it was really low, like 6.8%. But I thought that was a little too low, so I raised the WACC. The higher the WACC, the lower the valuation, and the stock still seems undervalued. There are a dozen companies in the same industry as Kroger, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. I'm planning to do 4 videos this week in the grocery industry. Kroger, Albertsons, Krispy Kreme, and Grocery Outlet. Let me know if you want me to do one of the others. Kroger spends the most in CapEx. When they construct a new warehouse, the cost of that warehouse goes into CapEx, and then it's depreciated over its useful life. Their debt to equity ratio is 1.7. For every dollar of equity, they have $1.70 of debt. They pay a nice dividend, 2.4%. Village Supermarket pays the highest, 3.9%. Really small cap company. They generate the most revenue, more than the other 11 companies combined. They're the biggest company in this industry, more than the other 11 companies combined. Price to book is stock price over book value per share, or market cap over equity. They're trading at 16.5 times earnings, which is a little better than median, 12 times free cash flow, a lot better than the median, and 0.2 times revenue. That means their market cap is 20% of their revenue. Or another way to put it, their revenue is 5 times their market cap. They're not growing as much as the other companies in this industry. Their 5-year annual revenue growth rate is 4%. The average is 7%. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $24,000 today. That's a 9% annual return. A couple of points you would have been in the red, but if you held on, you'd be pretty happy. This is their income statement, and this shows us 2021, 2022, and 2023. Their fiscal year ends 1/31, so this is their 10K. Look how much revenue they have, 150 billion. I wonder if that ranks in the top 100. I think it might be close. Here is a list of the top revenue generating companies. Walmart is number 1, 650 billion, then Amazon. Here's Berkshire Hathaway, Apple. CVS is 9th, Volkswagen is 10th. Google right here, number 13. Costco, number 20, Microsoft 21. Ford is number 30, JP Morgan 37, and here's Kroger 41. So they rank 41st in the world. It's pretty impressive. Walgreens, that went down a lot recently. Here's Meta. The reason Meta's market cap is so much higher than a company like Walgreens is because of Meta's margins. Their margins are much, much higher than Walgreens. Revenue is not the most important thing. Cash flow and profits are the most important thing. They usually go hand in hand, but certain industries have really low margins, like supermarkets, and other industries have really high margins, like tech companies. Verizon 51, Baba 52. Target is over 100 billion, they're at 65. Brookfield, Tesla 82. FedEx is number 99. Nissan is number 100. Let's go back to Kroger. So let's see if they give a breakdown of the revenue, the 150 billion. Here's a breakdown of the 150 billion. Non-perishable food is number 177 billion. That consists of grocery, for example, like canned tuna, general merchandise, like toilet paper, health and beauty products, like lipstick, and natural foods. It's a little more than half their revenue, 51%, and it's going up each year. Not only is it going up in dollar terms, but percent terms. Fresh food, 36 billion, which is about 1/4 of their revenue. That also goes up each year. That consists of produce like apples, flowers, meat, seafood, deli, bakery, and fresh prepared food. Maybe they make fresh sandwiches each day or potato salad. 11% of their revenue is fuel. They sell gasoline at some of the locations. That is down from 2022, and that could move with the price of fuel. They may be selling more volume, but the price has gone down. Pharmacy, 9.5%. That's up each year. And other, 6.6 billion, 4%. That consists of a lot of things. Maybe prescriptions. I think they also provide loans. They have Kroger Personal Finance. And you can see it decrease from 2021 to 2022. It also decreased again into 2023. And they mentioned the decrease is discontinued patient therapies at their Kroger specialty pharmacy. Let's go back to the income statement. All the direct expenses to generate the 150 billion of revenue is 117 billion. Because when they sell toilet paper, they have to buy the toilet paper. That's part of cost of revenue. The person ringing you up, the cashier, their payroll is part of this 117 billion. A lot of other expenses like advertising, transportation. If you want more detail on what these expenses are, you can just search merchandise costs and you'll get a lot more information. They mentioned that includes direct wages, repairs, utilities. It also includes advertising, like TV commercials. They spent 1.1 billion in advertising in 2023. Let's go back to the income statement. Below cost of revenue is operating and G&A, 27 billion. That's mainly employee-related costs, like their accounting staff, the legal team, the CEO, the CFO, all the employees that do not work at the stores. They have 900 million of rent, and they have a lot of fixed assets, all those warehouses, so they depreciate them, 3.1 billion of depreciation. So operating profit is down. Even though they had higher revenue, operating profit 3.1 billion. They spent 441 million of interest on their debt. And they give us a little more detail down here. Interest expense was 535 million in 2022. Now it's 441 million. The decrease is due to lower total debt. Income before taxes 2.8 billion. Income tax 700 million. So their net income 2.2 billion. EPS 299, which is down from last year of 310. Their shares outstanding went down a lot from 21 to 22, but they're the same when you compare 2022 and 2023. Diluted shares are down. It went from 727 million to 725 million. Let's take a look at the statement of cash flows. The first section is the operating cash flow, which converts net income into cash. Even though their net income was lower in 2023, they had more cash flow, 6.8 billion compared to 4.5 billion. It looks like they had a big negative in 2022 in inventory. So they bought a lot of inventory in 2022, but they sold a lot of that inventory in 2023. Every day they're buying and selling inventory, but the net difference is shown here. They sold 342 million more of inventory in 2023 than they bought. In 2022, they bought 1.4 billion more than they sold. In their investing section, they spent 3.9 billion of capex. These are the investments in property, plant, and equipment. They give more detail on the operating cash flow section. And they mention right here their operating cash flow is $6.8 billion, up from $4.5 billion. And the first thing they mention is inventory. Cash flows for FIFO, first in, first out, were more favorable in 2023 compared to 2022. And that's due to inflation in the current year. Also maintaining inventory at optimal levels through improved inventory management planning. There's only a couple of sentences in the investing section. They had a cash outflow of $3.8 billion in 2023 compared to $3 billion, and that's due to increased payments for property and equipment. The last section is financing. They had a cash outflow of $1.3 billion on long-term debt. They paid $800 million of dividends. They didn't buy much stock this year, only $62 million. Last year, $1 billion. Before that, $1.6 billion. We saw that in the income statement. Their shares outstanding were flat from the prior year. So now it makes sense. And they talk about it right here. We used $2.2 billion of cash for financing activities compared to $2.3 billion last year. They used less cash due to less stock buybacks, offset by increased payments on long-term debt, which is what we just talked about. Let's look at a company on Simply Wall Street. Its last price, $50, $36 billion market cap. Down a little bit in the past week, up 6% in the past year. It looks like they started trading way back in 1990. Under $2 a share, stock split adjusted. Over $16 in 1999. If you fast forward 14 years, it's still around $16. That was in 2013. It reached a new high in 2015 at 41. There was a slight market crash in the fourth quarter of 2018, and this stock got down to around $30. There really wasn't much of a dip during COVID. This stock pretty much held strong. And then it peaked in 2022 at $62 and never got that high again. In the past 2 years, it's been trading between $40 and $60. It got close to $60 in April, but it's been coming down in the past couple of months. Simply Wall Street's valuation is 74. They say they're 33% undervalued. 19 analysts priced this stock at 58. This purple line is the analyst price target, so you can see how that moves around. Their price target was 52 in mid-2023. So the forecast is for the stock to drop until the beginning of 2025. Then they're projecting a surge by mid to end 2025. The revenue forecast for 2027 is $155 billion, and the free cash flow forecast for 2027 is $3.2 billion. That's a forecast by 4 analysts. This red line here is their debt. It was $7.5 billion in 2013. The peak was $15 billion in 2018. They brought it down to $10 billion in February, but in the past quarter they added $2 billion of debt. Now their equity is a little higher than their debt. For a while their debt was higher. And the green line is their cash. They have $2.8 billion of cash. Their dividend back in 2014 was 1.3%. It peaked in 2019 at 2.8%. The forecast is 2.8% by 2027. The CEO's salary went from $1.3 million in 2018 to $1.4 million. Total compensation $16 million. His tenure as CEO is over 10 years. They employ a small army, 375,000 people in 2014. The peak was 465,000 in 2021. Now it's 420,000. And the ticker trades in lots of places: the New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa, London Stock Exchange, EuroTLX, Wiener Börse, Bulgaria, and Sao Paulo Bolsa. Their history dates back to 1883. It started with 23-year-old Bernhard Kroger. He was a German immigrant. He invested his life savings, $372. That's equivalent to $12,164 today. He invested the entire $372 into a grocery store in downtown Cincinnati. He used a lot of marketing tactics. He made sure to sell a lot of products and market the store really well so customers would not go to any other stores. In 1884, he opened his second store. By 1902, he incorporated Kroger Grocery and Baking Company. At this point, he grew it to 40 stores and sold $1.75 million worth of merchandise each year. And here's a little known fact: Kroger became the first grocery chain to have its own bakery. In 1916, he began using self-service shopping. Before 1916, all products were kept behind counters. So customers had to ask for them, then clerks would deliver them to customers. Talk about inefficient. And there was a rumor in 1929 that Safeway would merge with Kroger. And it took nearly a century before that rumor became reality, when Kroger announced in 2022 it would acquire Safeway's parent company, Albertsons. Beginning in 1955, Kroger began acquiring supermarket chains. This helped them expand into new markets. They entered Houston, Texas by acquiring the Houston-based 26-store chain, Henke and Pilot. Then they acquired the Crambo food stores of Appleton, Wisconsin. It then purchased Child's Food Stores of Jacksonville, Texas, and operated 25 supermarkets in Texas, Arkansas, and Louisiana. In 1956, they bought out the company Big Chain Stores, a chain of 7 stores based in Shreveport, Louisiana. In 1963, they acquired the 56-store chain Market Basket. This gave them access to the lucrative Southern California market. Before that, they had no stores west of Kansas. But they didn't have much success in California, so in 1982, they withdrew from the market. They opened stores in Florida from the 1960s until 1988, when they decided to exit the state. In the 1970s, they became the first grocer in the US to test an electric scanner, and the first to formalize consumer research. In the 1990s, they acquired Great Scott in Detroit, Payless Food Markets, Owens Market, JC Food Stores, and Highlander Foods. The Houston market was strengthened when they bought Apple Tree Markets, which were former Safeway stores, in early 1994. In 1998, they merged with the 5th largest grocery company, Fred Meyer, along with its subsidiaries, Ralph's, QFC, and Smith's. In the late 1990s, it acquired many stores from A&P. In 2001, they acquired Baker's Supermarkets from Fleming Companies. Albertsons exited the San Antonio and Houston markets in early 2002, selling many of their stores to Kroger. In 2004, Kroger bought most of the old Thriftway stores in Cincinnati when Winn-Dixie left the area. In 2007, they acquired Scott's Food and Pharmacy from Super Value. They also acquired 20 former Michigan Farmer Jack locations from A&P when A&P exited the Michigan market. In 2008, they began a partnership with Murray's Cheese in New York City. In 2013, they acquired 212 stores of Charlotte-based Harris Teeter for $2.5 billion. They have many chains under their umbrella. Just to name a few: Dillon's, Food for Less, Fred Meyer, Home Chef, Ralph's, Vitacost. They have their own fleet of trucks and trailers to distribute products to its various stores. In 2018, they started testing driverless cars for delivering groceries. They partnered with autonomous car company Nuro. They have a lot of manufacturing plants, 18 dairy plants in many different states. They have 9 manufacturing plants and 7 grocery plants. They have their own private label brand. It's called Our Brands, and those account for over 30% of their sales. Their big K products are for budget-friendly customers that account for $13 billion of their sales. There are some negatives. In 2021, a lawsuit was filed against Kroger. One of their employees committed suicide because he experienced so much abuse at the Kroger location in Milford, Ohio, where he worked for 19 years. According to the lawsuit, he was bullied for wearing a mask in the early days of the pandemic and taunted for his political views. Another thing that got them in hot water: in December 2021, they announced the elimination of some COVID-19 benefits. They said they will not provide 2 weeks of paid emergency leave for unvaccinated employees who contract COVID-19. They also said they're going to add a $50 surcharge to an employee's health plan if they're unvaccinated and non-union. So that's the end of the video. Let me know what you think. Like, subscribe, comment. Thanks for watching.